Hello and welcome to today's episode, which explains costing and pricing for exports, the general principles. Proper pricing, complete and accurate quotation, choosing the term of the sale and selecting the payment methods are four critical elements in selling a product or service overseas. Of four, pricing can be the most problematic even for an experienced exporter. In this episode, we will learn about the costing and pricing for exports. Before moving to details of today's topic, let me give you a quick introduction about myself. I am Ms. Pallavi Mohan, working since 17 plus years nationally and internationally. Worked in 5 countries and studied in 3 countries. Have held leadership positions in the field of marketing, retail, operations, PR and communication. Recent assignment was with Samsung Electronics as a corporate communication professional, contributing towards 4 countries. Well, let's get started with the details of today's topic. Pricing consideration. The price consideration listed below will help an exporter determine the best price for the product overseas. 1. At what price should be the firm sell its product in the foreign market? 2. What type of market positioning does the company want to convey from its pricing structure? 3. Does the exporter price reflect the product's quality? 4. Is the price competitive? 5th, should the firm pursue market penetration or market skimming pricing objectives abroad? 6th, what types of discount, trade, cash, quantity and allowances should the firm offer its foreign customers? 7th, should prices differ by market segment? As in the domestic market, the price at which a product or service is sold directly determines a firm's revenue. It is essential that a firm's market research include an evaluation of all variables that may affect the price average for the product or service. If a firm's price is too high, the product or service will not sell. If price is too low, export activities may not be sufficiently profitable or may actually create a net loss. Traditional components of determining proper pricing are costs, market demand and competition. Each of these must be compared with the firm's objective in entering the foreign market. An analysis of each component from an exporter perspective may result in export prices that are different from domestic prices. It is also very important that the exporter takes into account additional costs that are typically borne by the importer. They include tariffs, custom fees, currency fluctuation transaction, cost and value-added taxes. These additional costs can add substantially to the final price paid by the importer, sometimes resulting in a total of more than double the US domestic price. Foreign market objectives. An important aspect of a company's pricing analysis is determining market objectives. For example, is the company attempting to penetrate a new market, looking for long-term market growth, or looking for an outlet for surplus production or outmode products? Many firms view the foreign market as a secondary market and consequently have lower expectations regarding market share and sales volume. This naturally affects pricing decision. Marketing and pricing objectives may be general or tailored to a particular foreign market. For example, marketing objective for sales to a developing nation where per capita income may be 1/10 of that in United States are necessarily different from the objectives from Europe or Japan. Cost. The computation of the actual cost of producing a product and bringing it to the market is the core element in determining if exporting is financially viable. Many new exporters calculate their export price by the cost plus method. In the cost plus method of calculation, the exporter starts with the domestic manufacturing cost and adds administration, research, development, overhead, freight forwarding, distributor margin, custom charges, and profit. The effect of this pricing approach may be that the exporter price escalates into an uncompetitive range. If an export product has the same ex-factory price as the domestic product, its final consumer price is considerably higher once exporting costs are included. Marginal cost pricing is a more competitive method of pricing a product for market entry. This method considers the direct, out-of-pocket expenses of producing and selling products for exports as a floor beneath which prices cannot be set without incurring a loss. For example, additional cost may occur due to product modification for the export market that accommodates different sizes, electrical systems, or labels. On the other hand, cost may decrease if exporter products are stripped down version or made without increasing the fixed cost of domestic production. Other costs should be assessed for domestic and export products according to how much benefit each product receives from such expenditures. Additional costs often associated with export sales include 1. Market research and credit checks, 2. Business travel, 3. International postage, cable and telephone rates, 4. Translation cost, 5. Commission, training charges and other costs involving foreign representatives, 6th. Consultants and freight forwards, 7th. Product modifications and special packaging. After the actual cost of the export product has been calculated, the exporter should formulate an appropriate consumer price for the foreign market. Market demand. For most consumer goods, per capita income is a good gauge of a market's ability to pay. Some products may create such a strong demand, such as popular goods like Levi's, that even low per capita income will not affect their selling price. Simplifying the product to reduce its selling price may be an answer for an exporter to most lower per capita income markets. The firm must also keep in mind that currency fluctuation may alter the affordability of its goods. Thus, pricing should try to accommodate wild exchange in the US and/or foreign currency. The firm should anticipate the type of potential customers. If firm's primary customers in a developing country are expatriates or belonging to the upper class, a higher price must be feasible even if the average per capita income is low. Competition. In the domestic market, few companies are free to set price without carefully evaluating their competitors' pricing policies. This situation is true in exporting and is further complicated by the need to evaluate the competition's price in each potential export market. If there are many competitors within the foreign market, the exporter may have little choice but to match the market price or even underprice the product or service in order to establish a market share. On the other hand, if the product or service is new to the particular foreign market, it may actually be possible to set a higher price than in the domestic market. Pricing summary. In summary, here are key points to remember when determining your product's price. Determining the objective in the foreign market, compute the actual cost of the export product, compute the final consumer price, evaluate market demand and competition. Consider modifying the product to reduce the export price. Include non-market costs such as tariffs and custom fee. Exclude cost elements that provide no benefit to exporter functions such as domestic advertising, quotations and pro forma invoices. Many export transactions, particularly initial exporter transactions, begin to the recipient of inquiry for abroad that is followed by a request for a quotation. The preferred method for an export is a pro forma invoice, which is quotation prepared in invoice format. A quotation describes the product, states the price for it, sets the time of shipment, and specifies the terms of sale and terms of payment. Since the foreign buyers may not be familiar with the product, the description of it and overseas quotation usually must be more detailed than in domestic quotation. The description should include the following 15 points. First, seller's and buyer's name and address. Second, buyer's reference number and date of inquiry. Third, listing of requested products and brief description. 4. Price of each item. It is advisable to indicate whether items are new or used and to quote in US dollars to reduce foreign exchange risk. Fifth, appropriate gross and net shipping weight in metric units where appropriate. Sixth, appropriate total cubic volume and dimensions packed for export in metric units where appropriate. 7. Trade discounts if applicable. 8. Delivery point. 9. Term of sale. 10. Term of payments. 11. Insurance and shipping cost. 12. Validity period for quotation. 13. Total charges to be paid by customer. 14. Estimated shipping date from US port or airport. 15th. Currency of sale. Pro forma invoice are not used for payments purposes. In addition to the 15 items previously mentioned, a pro forma invoice should include two statements. One that certifies the pro forma invoice is true and correct, and another that gives the country of origin of the goods. The invoice should also be clearly marked pro forma invoice. Pro forma invoices are models that the buyer uses to apply for an import license, opening a letter of credit, or arranging for funds. In fact, it is good practices include pro forma invoice with any international quotation, regardless of whether it has been requested or not. When final commercial invoice are being prepared prior to shipment, it is advisable to check with the US Department of Commerce or another reliable resource for any special invoicing requirements that may be required for the importing country. If a specific price is agreed upon the guaranteed by the exporter, the precise period during which the offer remains valid should be specified additionally. It is very important that price quotation states explicitly that they are subject to change without notice. Terms of sale. In any sales agreement, it is important that there is a common understanding of the delivery terms, since confusion over their meaning can result in a lost sale or a loss on a sale. The terms in international business transaction often sound similar to those used in domestic business, but they frequently have very different meanings. For this reason, the exporter must know the terms before preparing a quotation or pro forma invoice. The following are a few of the more frequently used terms in international trade. CIF, cost insurance freight, to a named overseas port where the seller quotes a price for the goods, including insurance. All transportation and miscellaneous charges to the point of debarkation for the vessel, used only for ocean shipments. CFR, cost and freight, to a named overseas port where the seller quotes a price for the goods that include the cost of transportation to the named point of debarkation. The buyer covers the cost of insurance, used only for ocean shipments. CPT, carriage paid to, and CIP, carriage and insurance paid to, a name placed for destination. These terms are used in place of CFR and CIF respectively for all modes of transportation, including intermodal, EXW, X-Works, at named points of origin, where the price quoted applies only at the point of origin. The seller agrees to place the goods at the buyer's disposal at the specified place within the fixed time period. All other charges are put on the buyer's account. FAS, free alongside shipment at a named port of export, where the seller quotes a price for the goods that includes the charge for delivery of goods alongside a vessel at the port. The buyer is accountable for the cost of loading, ocean transportation, and insurance (FCA) at the named place. This term replaces the former FOB, named inland port, to designate the seller's responsibility for handing over the goods to a named carrier at the named shipping point. It may also be used for multimodal transport, container stations, or any mode of transport including air. FOB, free on board, at names, port of export, where the seller quotes the buyer a price that covers all cost up to and including the loading of goods. Charter terms. Free in is a pricing term that indicates that the charterer of a vessel is responsible for the cost of loading goods onto the vessel. Free in and out is a pricing term that indicates that the charterer of a vessel is responsible for the cost of loading and unloading goods from the vessel. Free out is a pricing term that indicates that the quoted prices including the cost of unloading goods from the vessel. It is important to understand and use sales terms correctly. A simple misunderstanding may prevent exporters from meeting contractual obligation or make them responsible for shipping costs they sought to avoid. When quoting a price, the exporter should make it meaningful to the prospective buyer. For example, a price for industry machinery quoted EXW Saguenay, Michigan, not export packed in meaningless to most prospective foreign buyers. These buyers would find it difficult to determine the total cost and might hesitate to place an order. The exporter should quote CIF or CIP wherever possible, as it shows the foreign buyer the cost of getting the product to or near the desired country. If assistance is needed in figuring CIF or CIP prices, an international freight forwarder can help. The exporter should furnish the freight forward with a description of the product to be exported and its weights and cubic measurements when packed. The freight forwarder can compute the CIF price, usually at no charge. If at all possible, the exporter should quote the price in US dollars. This will eliminate the risk of exchange rate fluctuation and problems with currency conversions. Pricing your product or service for international success. One of the challenges any company faces when looking to sell global is trying to set prices and the terms of sale for their products and services in foreign markets. There are many costs incurred in selling overseas, and before setting any price strategy, you need to ensure that all costing and all risk management costs and strategies have been factored into your pricing strategy. Factors that can immediately impact on your international pricing strategy and terms of sale and ultimately your profit margins include: 1. Currency exchange rate, 2. Economic conditions, 3. Production expenses, 4. Your competitors and the consumers in your target market, 5. Exporter transaction cost, 6. Risk management expenses, 7. Managing your freight cost. Before you enter any new market, you need to ensure that your price is competitive with what is an offer in the market, but you will also need to factor in the cost of marketing and managing your export transaction and risk management strategies. Getting your international pricing strategy right is crucial to the success of your business. It is difficult to go back and renegotiate your price once this has been set, and also you ultimately cannot risk potential not getting paid. Key consideration. In core terms, 2010, avoid costly misunderstanding by clearly defining the responsibilities of sellers and buyers for the delivery of goods. ICC's Incoterms rules are regularly incorporated into sales contracts worldwide. This module is a basic introduction to understand why Incoterms are vital to understanding your risk, but also your responsibilities and potential liability. Pricing for international markets an in-depth module that will guide you through the requirements for costing for international markets. Companies will be taken through a template costing guide and will have the opportunity to workshop through applying the basic rules for export costing. Risk management. This module will take you through all of the risks specifically associated with export documentation, transport and insurance. It is important that the companies understand how they manage their risk upfront and understand the added cost of exports so that they can set their international pricing strategy accordingly. Managing your foreign exchange risk. Understand the basic mechanism of managing your foreign exchange risk. International sales contracts. International contracts for the sale of goods and services can be complex. This module is an introduction only and will take companies through key considerations to look out for in any international sales contract, including: first, general characteristics of the contract; 2, scope of application; 3, termination of the contract; 4, dispute resolution; 5th, jurisdiction and role of law. In the era of global market economy and fierce competition, importance of accurate costing of product need not be overemphasized. Inaccurate costing can lead to either losing an order or losing of profits. Export prices is most important tool for promoting sales and contesting international competition. Exporter has to face domestic producers in the export market, producers in other competing supply countries and domestic producers in own country. Cost, demands and competition are the three important factors that determine price. The price for export should be realistic as possible. The exporter has to exclude cost of domestic production which are not applicable for export and add those elements of cost which are relevant to export product. Exporters has to compete with the manufacturer formal over the world. Hence, his price has to be realistic considering all export benefits and price in foreign market. There is no fixed formula for successful exporting price. It differs from exporter to exporter depending upon whether the exporter is a merchant exporter or manufacturer exporter or exporting through canalizing agency. Exporter has to assess the strength of his competitor and anticipate the move of competitor in the market of operation. Exporters can still be competitive with higher prices, with better delivery packages or added advantages. Following are few examples of such factors: range of product offered, prompt deliveries and continuity in supply, product differentiation and brand image, frequency of purchase, presumed relationship between quality and price, credit offered, price versus costing. There is a lot of confusion between the price and the cost. Many consider these equal. A few points to give you a mental picture of these points are as under. Price is what we offer to the consumer. Cost is the price that we incur for the product. Price includes our profit margins. Cost only gives the expenses we have incurred. Costing is the cost accounts privilege. Pricing is the marketing's man privilege. Export price. Once the ex works purchases price has been decided, the additional expenses that have to be added are as under: loading charges from work to truck, rail, air, etc., freight charges to port of shipment, clearing and forwarding charges, dock charges, terminology handling charges, freight charges to the destination port, insurance charges, insurance both to the port of shipment and destination commission interest charges, guarantee, warranty cost. In order to withstand international competition, the government offers certain exemptions and incentives benefits. These are additional realizations which tend to reduce the cost of your product. The following are few of them. There is no sales tax applicable on the final product. There is no excise applicable on the final product. Duty-free import of raw material, components and consumables is permitted under the Advanced Licensing Scheme. Income tax benefits under 80 HHC. Special import license credit of duty under the Duty Entitlement Pass Book Scheme. Any other special subsidy announced by the government. Special factors for exporting pricing. There are many unique factors relating to goods to be sold abroad. These factors influence their determination in comparison to those having bearing on pricing for domestic products. These factors may be delivery schedules, terms of payments, motivation of pricing, size of order, etc. Factors that increase price of export products. Special packing, making and labeling, additional supervision and effort for export product, export transaction cost, cost of export procedure, marketing cost, additional insurance cost. Factors that reduce price of export products, export assistance and facilities, refund or exemption from excise duty, lower price due to imported components and spare, export of raw material at international price, benefit of economy of scale. In order to ascertain the exact benefit that can be derived from export assistance scheme is the necessary first to locate the exact classification or SI number of the product under these schemes. The problem is exacerbated for products carrying specific brand names, as the brand rate may differ from all industry rates. This occurs, for example, under the duty drawback credit schemes, which provides relief on the customs and excise duties paid on raw material and component used in the export production. The exporter should be aware of two types of drawback rates. First, all industry rates. These are published in the form of government notification every year and are normally valid for 1 year. Second, brand rates. These are fixed at the exporter's or the manufacturer request, components, spare part, additional items. Finding out the rate of assistance for components, spare parts or additional items of the main product exported can be a problem. To determine the exact rate of assistance, it is necessary first to determine the exact classification of the product, which has to be priced. This is specifically important as the classification of a primary or main product may differ then from those of its components or accessories. The rate of assistance may sometimes be the same for the primary items and the co-product. Furthermore, there are common or general rates applicable to the products which are not classifiable under of the SI numbers, for which specific policies have been laid down. Where it is not possible for the exporter to determine the classification on their own, they may seek the assistance of the dispersing authorities or organizations set up to help them. In this episode, we covered costing, pricing of exports, general principles. That is all for today. Hope you have understood. We'll see you again with the next topic. Till then, take care. Bye.